G'day, my name's Robert Gowdy. I'm from Meriton Financial Group, and during this session I'm going to discuss the taxation of superannuation death benefits. Now, for many Australians, superannuation is close to overtaking the family home as the main asset in their estate. Now, for financial dependents of the deceased, the tax situation is as simple as it can be. In the vast majority of cases, the benefit will be paid tax-free. In some cases where there's an untaxed element, which generally comes from the payment of an insurance policy within superannuation, the death benefit payable to a non-dependent, the tax bill can be high as 30% at a time when you're still grieving for the loss of loved ones. However, it's becoming more increasingly common for larger superannuation death benefits to be paid to non-dependents like that, usually the adult children of the deceased. If most of the payment comprises of a tax-free element, which is made up of non-concessional or personal contribution, where the funds are being contributed to the superannuation fund with after-tax income, there's no tax payable. However, if most of the payment comprises of a taxable element, which represents the contributions from your employer, concessional contributions such as salary sacrifice, 15% tax will be deducted. This can be a significant amount for beneficiaries, but there are some solutions. Here's an example. Let's look at Eric, who's 63, has $1 million in superannuation, all of which is a taxable component. If Eric suffers a condition for which he's aware that he is terminally ill, he could withdraw the full $1 million prior to his passing. And since he's over 60, the entire amount would be tax-free. In this situation, no tax would be payable, even when it's passed to his beneficiaries from his estate. Now, if he were to die suddenly, the benefit would be paid to his adult children, and there'd be a tax bill of $165,000 would be lost. So that's the 15% plus the Medicare of 1.5%. So this is quite a hefty tax bill to hand over during a time of grief. As with most things in life, prior planning can help. So people aged between 60 and 65 and are no longer working can make a tax-free lump sum withdrawals from their superannuation and return them as non-concessional contributions. There are options for those aged 50 to 60, however there are potential tax consequences on the withdrawals. The recontribution funds then make up part of the tax-free component. Now, if a work test is satisfied, over 65s can also use this strategy, but due to limitations on the non-concessional contributions, this is a strategy that needs to be implemented earlier rather than later, particularly when large sums of money are involved. People can no longer contribute to superannuation and have large taxable components face a dilemma. The tax-free environment of superannuation pension is too valuable to ignore, but the subsequent death benefit may come with a significant tax liability. On the other hand, cashing out of super and investing outside of superannuation may create an ongoing tax liability. Over the long term, this could lead to a larger tax bill than the death benefit taxes. Of course, everyone's situation and circumstances are very different, so to ensure that the beneficiaries are not faced with a nasty tax on superannuation death benefits after you're gone, I'd recommend consulting a financial advisor to put an estate plan in place. Thank you for listening, and please remember this is general advice only, and I'd recommend that you read our general advice disclaimer at the end of the video. Thanks for listening.